Everyone, a very good evening. You're watching The Money Show on ET Now. This is our Diwali special programming as we say goodbye to yet another Samvat, and mind you, quite an eventful one, and welcome in a new. First up, on behalf of everyone at Team ET Now and Team The Money Show, let me take this opportunity to wish all our viewers season's greetings, a happy Dhanteras and a happy Diwali, and I hope that the next year brings you good health, happiness as well as prosperity. Now, every year, especially during the summer, it's a great opportunity to look back at your finances, the mistakes you made, the points you got right, and how can you ensure that you continue on the right path of creating long-term wealth in the years to come. And the best instrument to do so, especially for retail investors, is mutual funds. So let me now introduce on the show a very special guest. We have with us Nilesh Shah, the MD of Kotak Mutual Fund, who is often considered to be the last word on everything to do with mutual funds. Mr. Shah, many thanks for joining us today on The Money Show. And I wish you a very, very happy Diwali. I hope it brings a lot of health, good health, wealth and happiness for you and your family, sir.
Thank you for your wishes. And I wish all the viewers of ET Now very happy and joyous and healthy Diwali.
Thank you so much, Mr. Shah. You know, the year gone by has been a very eventful one with lots of lessons in terms of personal finance. The disruption to income and jobs taught us the importance of, a second income and a strong investment portfolio. Then we saw the fall, in equities, though, of course, we have recovered very smartly from there. But while there was that fall in equities, we saw gold skyrocketing, which taught us the importance of asset allocation. So every year, there are a lot of lessons we come away with, but this one especially. So Mr. Shah, let's start with that. What were, the key lessons for mutual fund investors in the Samvat gone by?
I think the three main lessons for this Samvat year, as well as coming Samvat year, as well as Samvat years gone by, remains the same. One, you have to be a long-term investor. There is a proverb which says that you can't expect mango before 12 years. When you plant a mango tree, you have to wait for 12 years. Second, you have to be a regular investor. Drops of water make an ocean. Same way, by doing regular investment, systematic investment, one can create a good portfolio. Third is the importance of asset allocation. It's impossible to time the market. But having a diversified portfolio across debt, equity, commodity, and offshore, it allows you to generate return which will be better than inflation. Don't put all your eggs in one basket is demonstrated in asset allocation. So any investor who did regular investment, who did asset allocation, and who took a long-term view has made money in this Samvat year.
Mr. Shah, we are often asked this question on the Money Show, especially when the markets were falling. In fact, we saw a flurry of questions in that March-April period that, the market has fallen, my mutual funds are not doing well, etc., etc. Is it possible really, to build a recession-proof portfolio of sorts with the three principles or philosophies that you mentioned? Or do you think that the ups and downs that we see, every 3 months or 4 months, or in a shorter time frames are really an inherent part of the long-term goal of wealth creation?
So we have always told people to do asset allocation. And many times people came back saying that, Nilesh Bhai, why don't you do what you are preaching us? So we created two funds. One is Kotak Asset Allocator Fund. Second is Kotak Balance Advantage Fund. In both these funds, we have done asset allocation looking at valuation of the market. Balance Advantage Fund invests only between debt and equity. Asset Allocator Fund invests in debt, equity and gold. Let me talk about Kotak Balance Advantage Fund. Last 9 months have been 360-degree journey. On 17th of Jan at 12,350 12,350 to Nifty, we were 39% invested in equity. Kotak Balance Advantage can go between 20 to 80% in equity. With the hindsight, we should have been 20%, but even 39% was kind of good. On 27th March at 7,801 Nifty, we were 75% in equity. In the hindsight, we should have been 80%, but 75 is also good enough. And today, as we speak, we are somewhere around 42% in equity at 12,500 Nifty. So we have bought when markets were cheaper, we have sold when markets were expensive. And doing this over last 2 years, we have outperformed Nifty by about 20%. So through asset allocation, you can reduce your volatility. You can improve your risk-adjusted return. But there is no fund manager, there is no fund which will deliver all the upside, but no downside. I can reduce upside as well as downside. I can improvise risk-adjusted return, but I cannot create a fund where there is no downside and all the upside.
Well, yeah, it's always tricky to do that, but sometimes retail investors expect wonders, really, from mutual fund managers and personal finance experts as well. Let's keep it to the point of asset allocation. We often say that, and like you as well mentioned, don't put all your eggs in one basket. And it was clearly demonstrated, that point was clearly demonstrated in when we saw equities fall, gold skyrocketing, debt managed to stay pretty resilient. And especially if you look at things like a gilt fund or those kind of funds, it's delivered even double-digit returns, some of these debt funds. So how do you advise investors split themselves across equity mutual funds, across debt mutual funds, and then of course gold ETFs as well?
So there is somewhere around 2x2 metrics which people have to keep in mind. One, what is their investment objective? And second, what is their risk profile? Now, depending upon your investment objective and risk profile, you will be able to arrive at standard asset allocation. For example, a 30-year young person looking for retirement will generally have higher risk appetite because he is young. Now, obviously, all 30 years are not alike, but we are trying to make a generic call here. A 70-year-old gentleman is likely to have lesser risk profile. So depending upon your investment objective and risk profile, you create standard asset allocation, which may say 40% in equity, 30% in fixed income, 20% in offshore assets, and 10% in gold. Now you juxtapose that with the valuation of the market. For example, in March, you would have been overweight equity, but now it is equal weight equity. Similarly, in March, you could have been overweight gold. Now it is equal weight gold. Fixed income, it's again equal weight. So today, if you see your portfolio, it will be more nearer to your ideal or static asset allocation because markets are in equilibrium. But in the month of March, you would have underweight fixed income and overweight equity and gold, and that would have played out very well for you.
All right. Another interesting feature which we saw was the way investors press the redeem button on mutual funds. Now, of course, it could also be due to the fact that many people, because of the pandemic and because of the income disruption, were hard pressed on cash. So they did resort to, redeeming their mutual funds to get a bit of extra cash. But that's a certain percentage. A certain percentage just saw this market rally as an opportunity to sort of, exit mutual funds, equity mutual funds for whatever reason. What would be your comment on this? I mean, are mutual funds to be looked as a vehicle where, you just sort of redeem or exit when markets are high?
So you should be redeeming when you need money because money is for your usage, not for remaining invested. Second, you should also redeem when your asset allocation results into overweight a particular asset class and the markets haven't been cheap in that asset class. So anyone who is redeeming because he is over invested in equity at this point of time is taking the right decision. But if someone is redeeming even though he is underweight, it's not a right decision. Yes, markets have jumped significantly from March level, but it still has room for upside. if you have a longer term time horizon.
All right. Mr. Shah, I'll request you to stay on with us, folks. I hope you've been taking notes of, all the mutual fund management lessons that Mr. Shah is doling out on the Money Show. We will take a very short break, but we'll continue with our conversation when we return. Don't go anywhere. Welcome back. You're watching The Money Show on ET now. We're in conversation with the MD of one of India's largest mutual fund houses, Nilesh Shah of Kotak Mutual Fund. Mr. Shah, we were speaking about how, or rather what are the principles to follow when one essentially invests in mutual funds. First, keep a long-term view. Second, proper asset allocation, and of course, diversification. Now, we always and often tell our viewers that, look, yes, mutual funds are for the long term, but it's often a good idea to check in with your portfolio. Keep a fixed time, a frequent duration in which you check in on how your portfolio is doing. So, it's a portfolio review process. And if they don't do it otherwise, maybe you can use the Samvat. The new Samvat is an excuse to check in on your portfolio. So, Mr. Shah, when an investor is looking at their portfolio, what should they keep in mind? These could be lay people who've entrusted their money with, Kotak Mutual Fund and other mutual fund houses. So what should they really keep in mind when they are sort of reviewing or checking in on their mutual funds?
So it is extremely important to check your portfolio on a regular basis. When we plant a mango tree, it doesn't mean that we stop watering it or taking care of a mango tree. We have to remove weeds around mango tree so that mango tree can grow. So regular watch of your portfolio is extremely important. Now there are various ways in which a common man can do this. One is do it yourself. You have to go through the portfolio in detail, see what the holdings are, whether it meets with your expectations or not, and what is the future return potential out of it. Now, this will require a reasonably good level of knowledge. To many common men, while they are capable, they don't have time to acquire this knowledge and do the work, which is where it is extremely important to have a mutual fund distributor or an advisor with you. When we are falling ill, we don't go to chemist shop and order medicine. We go to a doctor who prescribes medicine to us looking at our symptom. Like there is a professional doctor to help you choose medicine, there is a professional mutual fund distributor or advisor to choose right mutual fund for you. He will come to you at regular frequency to tell what is right in your portfolio, where profit needs to be booked, where despite losses you need to average. And this trusted mutual fund distributor or advisor will help handhold you during volatility and achieve your financial objectives.
All right. So if you think that, you have that financial savviness in you to check in on your portfolio yourself, see how it's doing, look at past performance, try and assess future returns, then great. A DIY approach to, reviewing your mutual funds. However, if you think that you lack the expertise when it comes to equities, when it comes to macros, which as well do impact equity markets at large, and of course mutual funds as well, then it's best that you go to a mutual fund distributor or a mutual fund advisor, and that individual would be able to guide you on how your mutual funds are doing. If there's something lagging, should you buy more and average it out, or should you perhaps consider redeeming partly, or whatever it is. Ensure that they are in line with your goals. So that's of course about reviewing it. Now, Mr. Shah, in the beginning I asked you about how many investors are pressing the redeem button on mutual funds, and you mentioned that you should redeem only when your goal is near. So let's talk a bit more about that. I mean, the whole we're investing in mutual funds to reap the benefits, the wonderful benefits of compounding that come along with it. So for you, when an individual's financial goal is coming near or objective is coming near, what's the best mutual fund redemption strategy? We often hear of SWPs, etc. But again, you have the whole tax angle as well coming in. So what's the best strategy to sort of cash out and, enjoy the wonderful benefits of investing in a mutual fund and the profits it gives?
So one cash out will happen based on your weightages. For example, let's say for a simplicity purpose, someone wants to put 50% in equity and 50% in debt. Now, in the month of March, his 50% equity would have become probably 30% and debt would have become 70%. So he needed to take out 20% from debt to invest in equity so that in the month of March, the ratio would have become 50-50. Now, markets have run up significantly. That 50% which he invested would have become now probably 80%, and debt would have become from 50% 20%. Now, this is not the market where you want to be overweight equity. You have made good profit because you invested at the bottom. Now take some profit out and make the ratio 50-50. Now here, obviously, there will be impact of taxation because if you wait for another 6 months, this will become long-term capital gain. So you may want to bring down from 80 to 60 right now and pay tax on something and keep something long-term. All those smaller adjustments are possible. But one profit booking will happen because of the performance. You have become underweight or overweight to your natural allocation. The second thing is, for the objective for which you have invested. For example, I had my daughter studying abroad. Now, whenever I had to pay her fees, it didn't matter where the market was. I needed to redeem money so that I can pay her fees. It didn't matter what the market level was. So you do a compartmentalization of portfolio based on your investment objectives. Whenever those objectives need money, please redeem. You don't have to worry about market level. But keep your overall portfolio balance in a manner that in cheap market you become overweight in asset class. In an expensive market, you become underweight in asset class.
Just as we wrap it up, Mr. Shah, I think everybody would also want to hear that what is Mr. Nilesh Shah predicting for the new Samvat? What kind of, we don't know whether there will be any more surprises or shocks that, the world will throw at us. But, as investors, as retail investors, what can we brace ourselves for?
So one, be optimist. I have seen that market gives us many reasons to be pessimistic. But eventually it is the optimist who makes money. Pessimist guy doesn't make money. Second, be disciplined investor. No one is able to tell what the future has hold. Last Diwali, no one could predict COVID-19. Forget Diwali, even in Christmas of 2019, we could not predict COVID-19, which was going to hit us in Feb and March. So markets are markets. They will go up and down because of various factors which we can't predict today. But if you are a disciplined investor, volatility will become your friend. My message this Samvat year, as well as past and future, will be optimist and be disciplined. These two factors will be good enough to make you a good investor.
Very simple mantra, optimism and discipline can help you become a good investor. And this is the word of advice coming in from one of India's largest mutual fund house, Kotak MF. Mr. Shah, as always, we really appreciate you taking out time to educate all of our retail investors and viewers of The Money Show. Many thanks for joining in, sir.
Thank you. Happy Deepavali.